This is the 5-minute chart on Euro US dollar on July the 26th, 2022. There's a breakout here with two legs. How do we capture this breakout? Let me show you. First, let's draw all the important levels. We have the pivot level and the previous day's low. And we also have the London Open here. After the London Open, the market didn't move much here. But we can still draw a trend line here connecting these 3 points. It seems the market follows the trend line very well. And then at the top, we can also draw a trend line. This is a down wedge. Normally for a down wedge, we're waiting for the breakout to the upside. However, this time, the market break down to the downside here. This breakout is very strong because there are 5 consecutive bear bars here, indicating the trend will have a second leg with a higher probability. After we see this breakout, normally we wait for the pullback and then wait for another good signal bar to trade. Which bar do we trade? That's the key to capture this breakout. When we see this bull bar has a small body, and then this is an inside bar for the previous bear bar. So we could have a possible conclusion that the pullback is shallow. So if the pullback is shallow, that means the trend is very strong. But it also depends on the following bars to see whether the other bars after that is big or small or bull or bear. Let's have a look at the bars one by one. First, this bull bar. It's not a good signal bar because in the 5-minute chart, normally we want to trade with the bear bar as the signal bar for the downtrend. For uptrend, we want to see a bull bar. So this bull bar is not a good signal bar for the downtrend. We don't enter after it finishes. Next bar is a kind of a doji bar. So the body is in the middle. We could possibly trade after we see this bar if we assume that this bull bar is already the pullback here, which is shallow. Then that indicates a strong trend. So you don't want to wait for another big bull bar because the market could go down right away. So if on that assumption, you can trade this bear bar. If you trade on this signal bar, then you're gonna enter the market in the next bar. So your profit target should be either this pivot level here. You can see that it touches the pivot level, or it should be a measure move from the first leg and measure the same down there. So it should be triggered before it reaches the pivot level. If you didn't enter the market and then you see the next bar, this bar is also a doji bear bar with a very big tail at the bottom. This is an indication of support, so it's not a good signal bar. And then the next bar, the same thing. It is a doji bar again, bear bar. So it's not a good signal bar because we're not quite sure. It lasted for 4 bars already, so the direction will become an issue. So at this time, we want to wait a little bit. Then you see the next bar. This is a bear bar as well, but the body is in the upside of the candlestick. So this is also not a good signal bar. And we wait again. Next, this bear bar is a very good signal bar because the body accounts over 60% of the whole candlestick here. So you can put your order after this bear bar finishes at the bottom of this bear bar. And then you can see the next bar, it triggers your entry. So still the same thing, the profit target should be here, or it should be the measure move. After the second leg finishes, here comes the question. These 2 legs are very strong with consecutive bear bars. Do you want to trade for the third leg? When you see the pullback and then when you see this bear bar, do you want to put your order again under this? It really depends. First, you want to know that what's the probability of this third leg going down. You should have your historical statistics to tell you whether you want to enter here, whether the probability is high enough for you to enter. Second, it's already reaching the pivot level. This pivot level is S2. What's the probability that the market will go down further to penetrate S2? That's another question. And third, so what's the probability for the third leg in general? Normally, it's lower than the second leg. So that's also a consideration. Fourth, it depends on your strategy. If when you enter at the pullback here, you choose to swing, for sure you need to hold your position until it swing out of your position rather than you have a specific profit target. But before you swing to the end, you should keep some position for scalping to take profit before you exit your position by the swing end. But if you choose to scalp for the second leg down here, so the probability for going down is low. So lower probability, probably you don't want to do the scalping again. So consider all of this. Do you want to trade for the third leg down? Here's what happened in the end. So there is a third leg down here. So if you swing your position for the second leg here, and then when you pulls back, and then you set your stop to the each of the pullback top. So that means probably you're gonna exit the market here, around here. So your stop should be at the top of this bear bar. So this means your profit target is very similar to here, which is the pivot level. But you wait for longer time, like over an hour, to get exit. If you choose to enter when you see this bear bar, then you can see that the market didn't go down immediately. Instead, it pulls back for the second time. And then if you see this bear bar, you can also enter the market again, but still the market goes back again. So you have to wait for a longer period, and then for this period, you're out of the money. And finally, after the 3 pushes here, and then the market finally goes down. But this bear bar can also serve as a signal bar, because combining the previous bear bar and this bear bar, so this will become a very good signal bar. And then in the end, the market goes down, but you can see that comparing to the first leg and the second leg, it's very slow. It's very weak as well. And then the question is, do you want to trade this? Really depends on the probability. From this chart, we can see that the third leg probability is lower, much lower than the second leg. And then it's slow. There are a lot of pullbacks along the way. And that's why it depends on your strategy. If your strategy is that I want to make quick money and then get out of the market, you shouldn't be trading for the third leg. If you are a patient person that you want to see the end of the trends, and then that's your strategy, you definitely want to trade for the third leg and then exit here. Even though exit here is similar to exit here, though you wait for a longer time, but that's your strategy. In the long run, if you do the swing for a long time, you're gonna make more money than scalping.